All right, future CMAs, let's get into it. Today, we're tackling a topic that is absolutely critical, not just for the exam, but for the survival of any business: cash flow projections. This isn't just about crunching numbers, it's about feeling the heartbeat of a company. So let's dive right in. I absolutely love this quote because it tells the whole story. Profit? Well, it's an opinion shaped by accounting rules. But cash? Cash is a fact. It's either in the bank or it isn't. And that's exactly what the CMA exam is testing you on: your ability to look past the pretty profit number and find the cold, hard cash truth. That's how you start thinking like a real strategic partner in a business. So, to really nail these questions, we first have to get our heads completely around this core distinction. It's all about switching our brains from the accrual accounting mode to the cash management mode. Think of it like this: we're living in two different worlds at the same time. The accrual world, that's your income statement. We recognize revenue when we earn it. But in the cash world, the only thing that matters is when the money actually hits our bank account. You see? A company can look like a superstar on paper, with record profits, but go bankrupt because they can't collect their cash fast enough to pay their employees. It happens. That's why this is a survival skill. Okay, let's get practical. The first method the exam is going to throw at you is the direct method. And 9 times out of 10, this means you'll be building a cash budget. This is a bottom-up approach where we're literally going to account for every dollar we expect to come in and every dollar we expect to go out. Every cash budget basically tells a 3-part story. First, cash receipts. This is all the money coming in. And listen, this is a favorite exam trick. They'll tell you the sales for April, but you have to figure out the collection pattern. Maybe you only collect 70% in April and the other 30% doesn't come in until May. You have to be so careful with the timing. Next up, cash disbursements. That's the easy part. It's all the cash going out. And finally, the financing section. This is the moment of truth. Do we have a surplus or do we have a shortfall and need to borrow money just to keep things running? Okay, everybody, lean in for this one. This is probably the #1 trap on the entire exam when it comes to cash budgets. Depreciation is not a cash expense. You never, ever write a check to Mr. Depreciation, right? It's just an accounting entry. So when you see it in a problem, what do? You just put a line through it and ignore it. It's a distractor, plain and simple. Don't you fall for it. Now for the other way to do this, the indirect method. This approach is more like being a detective. We're not forecasting from scratch. Instead, we start with the net income figure from the income statement, and we work backwards to find out where the cash went. It's all about reconciling that profit number with the actual change in our cash balance. And to make it super simple, I give you my Claire's rules. These will never fail you. Rule 1. An increase in an asset is a decrease in cash. Just think about it. If your inventory went up, you must have spent cash to buy it, right? So we subtract. Rule 2. An increase in a liability is an increase in cash. If your accounts payable went up, it just means you held onto your cash instead of paying your suppliers. So we add it. And our old friend depreciation? Since it was subtracted to get net income but no cash actually left, we have to add it back. See? It's all just simple logic. Now let's zoom out for a second. The CMA exam isn't just about being a human calculator. It's about thinking strategically. So we need to move beyond just, can we pay the bills, and start asking, what can we actually do with the money this business is generating? And that leads us to the king of all metrics: free cash flow. This is the really important number. It's the cash that's left over after you've paid for everything you need to run the business and made the necessary investments to keep it healthy. This is the free money you can use to pay down debt, give dividends to shareholders, or go out and acquire another company. This is the number that gets Wall Street really paying attention. So let me paint you a picture you'll definitely see on the exam. A company has soaring profits. Looks amazing on paper, but you run the numbers and find out its free cash flow is negative. Whoa, that is a massive, flashing red flag. It's a classic sign of a business that's growing broke. They're selling a ton, but all their cash is getting sucked up into inventory and accounts receivable. This company is walking on a tightrope. Okay, let's wrap this all up and get you ready for exam day. I want to give you a powerful little checklist, your secret weapons for any cash flow question that comes your way. Here they are, my 3 clarified tips. First, master the lag effect. Remember, sales in one month do not equal cash in that same month. Always check the collection timing. Second, ignore the non-cash distractors.
The second you see depreciation in a cash budget problem, just physically cross it off your paper so it doesn't tempt you. And third, don't forget the minimum balance. Companies don't borrow just to get back to zero. They borrow to get back to their required safety cushion. It's a key part of the puzzle.
So I'm going to leave you with this one question. This is the lens you need to look through for every single problem. Is that high profit figure hiding a major cash crisis? Your job as a CMA is to always ask, where is the cash? If you can answer that question, you're thinking the right way. Keep practicing, you've got this, and I'll see you in the next explainer.